Yeah, so thanks for having me. It's great to be back talking on this forum again. My name is Lucas. I am the smart contracts tech lead at a DeFi startup called Maple Finance. We're a protocol on Ethereum mainnet. And basically at a high level, we are a institutional capital marketplace that's designed to allow corporations to borrow capital efficiently on Ethereum. So essentially what has happened over the last couple of years, mainly in the last 2 years, is a lot of really strong crypto-based institutions have arisen. Very successful businesses that have really strong balance sheets. Specifically, trading funds and like delta neutral market makers are two big institutions that we're focusing on, but also crypto miners and exchanges. So essentially, what's happening with these businesses is they're, like I said, doing very well, making a lot of money. And these, like the delta neutral market makers, for example, are actually not influenced by the volatility in the market. They're making revenue whether the market's going up or down. And they need to borrow capital to grow their businesses, but they're having a really difficult time doing that through traditional banking means because traditional institutions don't really want to touch them because of their crypto native nature. So we're leveraging our knowledge in the crypto space as well as just DeFi to facilitate the borrowing of capital for these businesses to grow using Ethereum and smart contracts. Before I keep going, one of the main ways to borrow capital using DeFi was using over collateralized loans. So protocols like MakerDAO, Aave, and Compound are the big three. Basically, these protocols don't know who you are. You're just an Ethereum address. So because of that, they basically have to treat you as if you were a malicious actor. So because of that, they'll lend you money, but only if you over collateralize your loan. So if I want to borrow $100, I actually have to put up $150 as collateral to over collateralize that loan. That way, pretending I'm a malicious actor and I run away with the $100, the protocol is completely solvent and actually doesn't care that I ran away with the money because the value backing it is worth more than the debt. So the issue with that for these businesses that are trying to grow is that it's not capital efficient, right? If they're trying to grow their business, they don't want to have to add a very large amount of collateral and over collateralize a loan if they're trying to expand their business. They want to be able to borrow capital under collateralized or with actually like zero collateral in some cases. So in order to do this, they have to leverage their reputation as institutions. So this is we're leveraging the fact that these companies are, they're large and they're well known within the crypto space at least, and they're staking their reputation and trying to improve their credit worthiness through our platform so that they can borrow more and more capital as their businesses scale. So essentially we have 4 main actors in the protocol. So we have our lenders or our liquidity providers, our Maple holders, the Maple token holders, which I'll go into in a second, our borrowers, who are the institutions that I was referring to earlier, and then the pool delegates. So essentially what we're doing on the actual blockchain is we're gathering capital into smart contracts. So there's something that we have called a lending pool, which we're taking USDC currently, which is just US dollars. So users can deposit US dollars into a lending pool, and it doesn't matter where you're from or your financial background. You can just deposit USDC. We don't really look into who is depositing. It's just like you can be from India, South Korea, Canada, US, wherever you come from, we're accepting your capital. And this capital is aggregated into a large pool of funds, and that pool is controlled by what is called the pool delegate. So the pool delegate is a highly experienced, reputable basically a fund manager. So this is usually an institution. We have 2 institutions working with us currently, 2 pool delegates that are controlling the funds and basically performing the underwriting process for performing all of the loans to the borrowers. So the borrowers come to the platform and they say, hey, I'd like to borrow $2 million for 3 months. I'll pay 10% interest. And then the pool delegate goes through and actually evaluates all their financials, checks their credit worthiness, and goes through the underwriting process and determines the appropriate, risk-adjusted terms for the loan in order for them to actually facilitate the loan. And in exchange for that, the pool delegate earns a small fee on the total amount of the loan that the borrower is taking. So the nice thing about this is both parties kind of benefit, right? Because the pool delegate is able to control this large pool of capital. Currently, we have over $200 million under control in our protocol. I believe the split is 120 million and 100 million, but I'd have to double check that. So we have the 2 pools, and so these pool delegates are controlling these large pools of capital and are able to allocate them to different borrowers and earn fees. And what is nice about this is the lenders have a very easy set and forget solution to deposit US dollars into a protocol and earn very high yield interest on these loans. And they don't have to do any work for the underwriting. Currently, our loans are, actually, I'll bring up the website later. I'll go through the APY. And then, so the last thing here is our stakers. So one of the possibilities of an under-collateralized lending platform is the actual possibility for real defaults to occur. Because we are extending real credit to borrowers, there's real credit risk. So because of that, we have what's called a staking pool, and users can stake against a given pool to provide insurance. So in the case of a default, they would be the set of first loss capital. So if we have a $2 million loan with $1 million of collateral and they default on their loan, we would liquidate their collateral, recover $1 million, but there's still $1 million of shortfall. So instead of passing that loss on to the liquidity providers or the lenders, we would liquidate the staking pool's assets and recover as much value as we can from that before passing the losses on to the liquidity providers, if we need to. So in exchange for that, the stakers are earning a higher yield because they're taking on more risk. So the lender benefits. As a lender, I've personally gone and lent in the Maple protocol, and it was a great experience, very smooth. So basically, you deposit USDC, and you're automatically exposed to a diversified set of loans with an ongoing accrual of interest from many different sources. So that's great because you have this baked-in diversification as well as a nice set and forget yield solution. And as I mentioned before, you have protection from defaults from the MPL reserve. So in the rare case of a default, you do have protection, a sort of insurance. And it is a nice sustainable yield. So in protocols like Compound, Aave, and Maker, the interest rates that are determined by those protocols is for the demand of the underlying asset. So if you deposit USDC into Aave, people are borrowing that USDC and paying you interest, but that is a variable interest rate that fluctuates with the demand for that asset. So it's not necessarily a very sustainable source of yield. It is, definitely a source of yield that is very real, but it definitely can fluctuate with market conditions. Whereas our yield is a much more steady, predictable source of yield because it's based on companies' demand for growth capital to grow their businesses. So it's slightly correlated to the market, but not nearly as much as an automated capital markets, such as Aave or Compound. And then, yeah, the borrower benefits. There's a lot of benefits for borrowers on our protocol. So there's a lot of different sources where a borrower can go and borrow capital under collateralized. I shouldn't say a lot. There's a few, but mainly a lot of them are based in centralized finance. So there's centralized entities that are crypto-based that lend out capital. But the benefits of our platform is that you only need to get onboarded once, really, and then you can perform a relationship with the pool delegate. And then compared to some of the other decentralized under collateralized lending platforms, we actually have a confidential assessment process, which is completely different from, one of our main competitors is TrueFi, which is another under collateralized lending platform. And in order to borrow capital under collateralized on their platform, you need to essentially make a public application to borrow. So everyone sees all of the information that is necessary to perform the underwriting process, which is not the case in Maple because we have the pool delegates. So the pool delegates can have a confidential exchange of information with the borrowers, which is highly beneficial for the borrowers because they don't have to disclose their financials to the public. And continuous feedback on loan terms. As you continue to borrow and refinance loans, loan terms can get updated, and as you get a better and better relationship with the pool delegate, you can get more and more preferential loan terms, lower interest rates, lower collateralization ratios, etc. And then the last big benefit is that borrowing over collateralized on, again, a protocol like Aave, Compound, or Maker, you have to consistently monitor your position because the value of your collateral can fluctuate with the market. So if you are staking $150 of Ether to borrow $100, that actually can go to $120 within a day. We've all seen significant market downturns in crypto. So it's a much more active and frankly stressful way to borrow capital when you have to monitor the price of your collateral all the time. And so instead of having a price-based liquidation mechanism, we have a time-based liquidation mechanism. So we have a schedule of payments that are pre-agreed on when you create a loan. And if you're late on a payment, you have a grace period, which is currently 10 days. If you're late, we give you 10 days. You can make a late payment. You pay a late fee. But if you're past the 10 days, the pool delegate has the option to default your loan and liquidate your collateral. But it's not based on any sort of market condition. It's based on the borrower not paying their loans payments on time. So it's a totally different approach. So yeah, Maple, this is slightly out of date, but Maple's platform has received $217 million in deposits and completed $200 million in loans to our top tier institutional borrowers. So yeah, these are some of the names that we're working with. You may or may not recognize them. But Orthogonal Trading and Maven 11 are our two pool delegates. Our borrowers are Alameda Research. This is our biggest name that we're working with. They're affiliated with FTX, and they're a very large and very successful business. Framework, Wintermute, all of these are very highly successful businesses and have very large appetites for borrowing. And we actually have an imbalance, you could say, of demand and supply. We have a very large, like I said, very large appetite for borrowing on the borrower side, but the lender side, we just need to get more capital on the platform as fast as possible to facilitate this scaling demand for borrowing capital. And then the last thing that I'll talk about here, or second last thing, I guess, is the MPL token utility. So participants provide USDC liquidity to Maple Launch Pool for a 6-month lockup. This is actually now a 3-month lockup. And they earn yield on USDC plus they earn yield in MPL tokens. So MPL tokens have a couple of uses. The first is governance voting rights. Maple is currently using the tokens to facilitate governance decisions off-chain, but we plan to eventually be a token-based DAO, or a decentralized autonomous organization. So users can vote on decisions to be made in the protocol purely using smart contracts and tokens. That's how MakerDAO works, for example. It's very interesting and just very cool. You can stake MPL in liquidity pools, which I mentioned before, to provide that reserve of first loss capital. So you need MPL in order to do that. You can earn dividends from the establishment fees that are charged when borrowers draw down on loans. So whenever they draw down on loans, a small establishment fee is paid to our treasury, and we distribute those revenues to our token holders. So you can earn by holding MPL tokens. And we have a fixed total supply of $10 million, or 10 million tokens. So though a lot of those are held within our treasury, but there is a circulating supply. But the total supply in existence on Ethereum is 10 million, and that can actually never change. And so I'm not sure if our listeners are familiar with liquidity mining, but it is a very interesting new concept that's come out in the last 2 years. Essentially what liquidity mining is we want to incentivize users to add capital to our platform. So we need to incentivize them. We give them their interest in USDC, which is very high, but we add a little extra on top, which is a steady issuance of MPL tokens. So the comparison that I always make is if you were like a competitor to Facebook, for example, you could actually issue Facebook or the Facebook competitor stock to your users the more they use your platform. So the more your users use your platform, they're actually earning equity in the platform itself over time. So it's a highly it's a very new concept, and it's very interesting for incentivizing users, because not only are they earning more, but they actually have skin in the game going forward in the platform's development. So it increases the loyalty of your users by quite a lot as well. So one thing I'll just really quickly show people who are interested is our website. So this is maple.finance. This is our website. You can go here and play around, but essentially we can go and explore Maple. So this is our platform. Oops. So we have our two pools here. I'll go into one of our orthogonal trading pool. So you can see here the aggregate APY is 48.6%. So that means that if you deposit $1,000 of USDC, you'll earn a yearly yield, an annual yield of $486. So it's an extremely lucrative program. Let me just show you also Dune Analytics. This is I'll actually post both of these links into the chat here if you guys want to look around, but this is an insight into our protocol's more analytical side. So this is, all of our deposits to date, how much our treasury has earned, total interest that's been paid, and things like our actual interest rate in USDC over time. So this is, you can see here, Maven 11 in orthogonal trading. Orthogonal trading currently is earning a USDC only annual yield of 11.6%. So if you deposit USDC in that pool, you can earn 11.6% annualized yield. But including our liquidity mining program, that is where that other 30% annualized yield comes from, is from the liquidity mining. So the aggregate yield that you're getting is roughly 48%. So yeah, and you can see all the outstanding loans here. You can see the loan amounts to each of our borrowers. You can see, the majority of them are actually 0% collateralized. So the most capital efficient option for our borrowers. And our interest rates vary between 8 and 12 to 13%, basically. So yeah, that is my presentation.
So look, let's jump into some questions. A question from me. I said, are Maple going to start lending and taking capital in Bitcoin? Is that on the cards?
So sorry, are you saying lending Bitcoin and earning interest on Bitcoin?
Yeah. So like we're kind of lending US dollars. Is that kind of on the horizon?
Definitely.
Something that might be.
So we have quite a few assets in the pipeline. We've started with stablecoins just because it's kind of the most obvious use case, but down the road we do have borrowers asking for pools, with link tokens, WBTC tokens, Ether, whatever, because they're market makers, so they want to be able to post these assets on either side of the market and earn funds that way. So there actually is a demand to borrow those tokens natively. And in addition, down the pipeline, we're thinking about adding a more sophisticated staking module. Mm-hmm. So if you wanted to, you could stake WBTC against a pool instead of MPL, and you could earn that yield on top of the WBTC itself. So that would be another potential opportunity to earn a high yield on an asset like WBTC.
They're onto it at Maple. They know what's going on. Awesome. Cool. We've got another question here from David. David has asked, how is KYC and regulation impacting the design of the Maple protocol and where the product can be offered?
Yeah, so KYC is a pretty big part of our protocol. It's a very big part, I should say. All of our borrowers that get onboarded to the platform are KYC'd, and they sign a master loan agreement, which is legally enforceable in the case of defaults or whatever. What we are investigating is because there is a lot of interest in our protocol from both sides of the market, lending and borrowing from large institutions and some of them from traditional finance. But understandably, they're concerned about regulation and being in accordance with U.S. regulations. So we are thinking about making a completely KYC'd lender pool. So only KYC'd lenders would be able to add capital to this pool. So all the borrowers would know where all the capital has come from. So it'd be like a completely enclosed system. So that is in the pipeline, something that we're looking at. But yeah, definitely KYC is a big part